With a healthy dividend yield, SCHD over the past 5 years has beat many of its peers. And it's even beaten the S&P 500 over the past 5 years. If you look back over the past 3 years, you see the same thing. SCHD beating its peers and the S&P 500. But here's the thing. If you look back over the performance during 2021, SCHD started lagging behind. While it still had a 26.97% rate of return, many of its peers did better than it. And it didn't beat the S&P 500 that year either. And if you look year to date, it's also lagging all of its competitors, but it is beating the S&P 500 this year. So in this video, we're doing a deep dive into SCHD. We'll go over how it selects its universe of stocks, the factors that it leans on, and how some of those factors that it uses may actually lead it to lag some of its peers over the next couple years. This is going to be a really good video, so I hope you stick around. So let's go ahead and let's get started. All right, so quick shout out. Thank you, Leroy Skywalker. Awesome name, by the way. Thank you for your comment. Very insightful comment that you left on my best large cap dividend ETF video. In that video, I discussed a bunch of different large cap dividend ETFs. SCHD was the one I picked, but I did say that I would want to supplement it with something like a VYM. That wasn't the case a year ago, but it is today. And so I have some concerns about the short term of SCHD, but not about the long term of the ETF. I think long term, this ETF will of course do very well. So it's really about the next couple years that I think that this ETF may potentially underperform its peers. So what we're going to do in this video is we're going to actually compare SCHD and its selection process to VYM and its selection process, which VYM is the Vanguard High Dividend Yield ETF, and we're going to see how they compare and why I think some of the factors that are in SCHD right now could end up hurting some of its return in the next couple years. So first we have to understand that SCHD aims to track Dow Jones US Dividend 100 Index. SCHD tries to replicate the methodology that this index uses. Now you can find this in a PDF on S&P Global's website. This is called the Dow Jones Dividend Indices methodology. So what I'm getting here is what SCHD should be trying to replicate for its specific ETF. Now VYM uses the FTSE High Dividend Yield Index, and it's derived from the US component of the FTSE Global Equity Index. Like Schwab, Vanguard tries to replicate this index's methodology that's created by FTSE. So the first thing that SCHD and VYM do is they have to define their universe of potential stocks. So VYM selects this by saying that they won't invest in any REITs, so no real estate investment trusts. They use the US component of the FTSE Global Equity Index series, and they will only select stocks that pay higher than average dividends. So this is actually a pretty easy methodology to figure out what the universe of stocks is going to be for Vanguard's ETF. Now SCHD's is a bit more complicated. Like VYM, they won't invest in REITs. They'll actually use the Dow Jones US Broad Market Index, but then SCHD needs to pass 3 screens to have a stock considered to be in its universe of potential stocks to invest in. The first screen is that it has to have a minimum of 3 years of dividend payments. Next, it has to have a minimum float-adjusted market capitalization of 500 million. So actually, smaller cap stocks can actually make it into SCHD. And it has to have average daily volume trading of at least 2 million shares. So you can't have thinly traded stocks end up in this ETF. And then passing stocks are ranked in descending order based on IAD yield. So that's just essentially the dividend yield. And then the top half of those securities based on the ranking are eligible for stock selection. So what this is saying is it finds only stocks, of course, that pay at least 10 years minimum dividends. So that's important. It has to have a certain amount of volume. It has to be a certain size. But then it takes all of those stocks that are in those categories and it ranks all of the dividends. It basically strings it from the highest dividend paying to the lowest. For example, let's just say there's 500 stocks in that range. Well, it takes only half of them. So it takes 250 of those 500 stocks. And those 250 are available or eligible. Now remember, VYM only takes the top half of the highest paying dividend yielding stocks. Now take this strategy and put it next to VYM. Well, VYM also basically ranks the stocks by dividend yield, just from highest to lowest, but then it takes the average of all those dividend yields, and only the stocks that are above the average make it in. So again, if VYM had 500 different dividend stocks, it would take the average of all of the yields of those stocks, and then all of the stocks that are above that average are going to make it in, and all of the stocks that are below the average are not going to make it in. Now what this does is it creates a much larger portfolio of stocks for VYM, which has closer to 300 stocks in it than SCHD, which has 100. So that 100 stocks that SCHD ends up picking are picked through this selection process. They're ranked by 4 different fundamental factors. Free cash flow to debt is one of them. Now companies with 0 total debt are ranked first. Now remember that, because that's going to be one of the important parts of this. Return on equity is a factor, so you'll get more points if you have higher return on equity. The higher the yield, the more points you'll get as well. And if you have a high dividend growth rate, you're also going to get some points as well. They take these 4 components, they create a score for all the different stocks, and this top 100 stocks based on this score get to enter the SCHD portfolio. Now how do they decide which stock gets more weighting? Well, they don't equally weight this portfolio. Not every stock is 1% because there's 100 stocks. Some stocks have higher percentages. So what they do is they base it on market cap. So larger companies get a larger piece of the portfolio selection. Now, no stock can be more than 4% of the index, and no specific industry is allowed to be more than 25% of the index. So for example, after the ranking, if there was a specific industry that has, let's say 50 stocks that would have made it into SCHD, they're only going to allow 25 stocks in because only 25% can be in one sector. Now it's rebalanced annually, and then there's quarterly updates. Now this is an important part. So during the annual review, constituent stocks will remain in the index as long as they are among the top 200 rankings by composite score. So what this is telling me is that it's actually pretty hard to get kicked out of this index. Basically, if the component score was not in the top 100 anymore, but it was between 100 and 200, the company's still going to be allowed to stay inside the index. Now, in my opinion, this is probably one of the negatives of this selection process. It's good because, it prevents portfolio turnover and things like that. But on the other hand, a stock that's actually ranked like 180 instead of the top 100 is still going to be considered inside the index because it's harder for it to get kicked out unless it's 200 or worse. Now, if 2 constituents have the same composite score based on that 4 fundamental factors, the higher dividend yield is going to be the one that's selected. And there's also something called a daily weighting cap check. So if the sum of stocks with a 4.7% weighting in the portfolio is higher than 22% of the stocks, then the index is reweighted. Then there's some other specific things about when you can reweight and a freeze period and stuff. But anyway, essentially, SCHD is composed using this method, and VYM, by the way, once it gets all of the dividend stocks that are higher than average, it ranks them based on market cap. So VYM is a much easier replication strategy than SCHD, which has a much more complex ranking of the stocks based on those 4 different fundamental factors. So hopefully you understand how the selection process works for both of these funds. So what I wanted to do now is discuss why I think some of these factors may not work that well in the next couple years. Now, if you've watched my videos, then you know that I have some specific sectors that I think are going to do well, for example, this year, and those include energy, financials, and consumer cyclical. Now, on top of those 3 sectors, which everyone knows about, as we get closer and closer to the end of this first quarter, more of a defensive style with some utilities, I think, could also potentially be a benefit as well to some of these ETFs. And so what I want to walk through here is why there are certain sectors that SCHD is just probably not going to end up picking stocks in these different sectors because of the weightings and the methodology they use for those fundamental factors. So let's talk first about this first characteristic that Schwab uses in its fundamental rankings. So free cash flow to debt. And it says companies with 0 debt are ranked first. So to do well in this factor, you can't have a lot of debt, which of course is not a very bad thing in general. To have no debt as a company is great as long as you have good other fundamental characteristics there. Awesome. But there are inherently some industries that utilize debt and they need to. And so those industries, if you think they're going to do well, they're not going to end up in an ETF like SCHD. Or maybe I shouldn't say they're not going to end up there, but the factor here is not going to be very beneficial for a company like that. And so if you think companies that utilize more capital and more capital expenditures are actually going to do well, then this particular selection ranking is not going to do very well for that type of company. And so companies with lower debt are actually going to do better in this one. So think of companies with lower debt. So tech companies, semiconductor companies, right? So companies that don't have lots of debt are actually going to do pretty well in this factor, which is likely one of the reasons why we see quite a few semiconductors inside the CTF. So next you have the return on equity, and some industries are inherently going to have better return on equity than other industries. So in this spreadsheet, I actually have the different return on equities per specific industry, and you'll see these are the higher return on equity industries, and you'll see red here are companies in an industry which I don't think is going to do as well in the next 2 years, which is essentially technology. Semiconductors would be in there, retail online, software entertainment, software systems applications. I don't see those doing as well this year as some of the other sectors. So essentially what I think is going to do well, like I said, financials and energy. So you don't see that in the top here. You don't see financials and energy in the top here. You see these more semiconductor companies and more tech companies. Now here we have the opposite. This is return on equity by the lowest return on equity. And the lowest return on equity you'll see are companies like oil and gas production exploration, oil field distribution. So this sector, which I do think is actually going to do pretty well going forward over the next couple of years, is not going to do very well in that fundamental ranking selection, right? So that's one of the things I'm saying here is that companies like that are in these industries are not probably going to be as represented in SCHD, but I do think those industries are going to do decent or better in the next couple of years. And that's why I think some of its peers, the peer ETFs, the competitors of SCHD, which do have companies like these, are maybe going to be outperforming because they're not using these selection processes that are preventing companies like energy companies from being inside the ETF. So I couldn't find data for debt to free cash flow really, but we do have debt to equity. So if you look at debt to equity ratios, software equipment, software systems, semiconductors, they have the lowest debt to equity of the different industries, right? So the lower debt to equities, the lower return or the higher return on equity companies are probably going to do pretty well in an SCHD. They're going to get into the SCHD ETF. And this just shows that those are the different industries that likely will probably make it into this ETF. They'll have a decent weighting in the ETF. On the other side, here's debt to equity of some of the bigger banks, for example, the JP Morgans, the Bank of Americas, the Wells Fargos of the world, right? This is only 7 different companies, but those 7 companies, those large banks, they have the highest debt to equity ratios. And so they're not going to be as highly ranked because they have higher debt probably to their free cash flow, in that factor at least. Now another thing you see here is utilities, which I do think is a very defensive sector right now to have potentially. And utilities are probably not going to do very well either in this because utilities have decent debt. The same again with oil field services and equipment. So this is something to take into consideration, in my opinion, what these factors are going to limit and what they're going to actually allow to go into SCHD. Another thing to mention here is that companies with very low debt to equity, software systems and application is one of the largest industries that there is, and it has the lowest debt to equity and probably a good debt to free cash flow, meaning that a lot more potential companies will be available to go into this ETF because there's so many of the companies that are going to do well in that factor. And also, if you remember, this industry was actually represented in the higher ROE as well. So it gets good high ROE, it gets good debt to equity, higher potential chance that as long as these companies pay dividends that are growing, they're going to be in SCHD. And so now looking at the weightings of the different sectors inside SCHD and comparing it to its 2 peers, SPYD and VYM, we can see some interesting things. So energy, for example, SCHD only has 2% in energy, which, like I said, the fundamental factors are not weighted towards having energy being entered into SCHD, when VYM has 8.8% and SPYD has 13.4%. And energy has been the best performer so far this year in terms of sectors. Now, in terms of information technology, which you don't likely think of as a dividend ETF having lots of information technology, but SPYD has almost no IT, and then VYM has 10.4%, but SCHD has 20.4% in information technology. Again, a sector I don't think is going to do as well this year at least. And then again, in terms of defensive, if you're looking for defensive stocks, utilities, there is no utilities in SCHD because of the selection process. It's likely not going to have a lot of utilities that are going to make it into that selection. So at the end of the day, I think SCHD is going to do very well over the next 5 years. I think at some point in time, the information technology sector will do very well. I think we're not going to need utilities as defensive, and I think energy will eventually get overvalued. But the way I see it right now, I think energy is still undervalued and there's a lot of room to grow. I don't think IT is going to be a very good sector to invest in over the next year or two. And I think utilities have a decent, argument to be inside of a dividend portfolio at this point in time with what's going on in the market. Now look, you may not agree with the sectors I think are going to be good this year, and if you don't, then probably all these things I said today don't really matter to you. But if you do think energy might do well this year, if you think bigger banks, bigger financial companies are going to do better this year, if you think utilities having some defensiveness inside of a portfolio might be important, then SCHD right now isn't going to probably have a lot of those things in it. So anyway, that's my 2 cents on this thing. I hope you liked this video. Hope you learned something. And you know what? If you did, please hit the like button, subscribe if you want to see more content like this. Let me know in the comments if you like this. I'm trying to get to 2,000 subscribers. Please hit that subscribe button and watch another one of my videos coming up on the end screen right now.